So tell me, Jerome, when are you hiking rates?
I am not Jerome. I wish that I had that power to move short-term the Fed funds rates. I do not have that power. What I do have is a lot of data at my disposal. And Pete and I are going to unpack a bunch of historical context and data around when the Fed will hike again, Pete. This is a funny thing. And I wrote about it for this week's newsletter for subscribers. And if you're not ready to join our small exchange community, you can also get this commentary and statistics, some of it at least, for free at go.smallexchange.com/light-confirmation.
It really is.
URL is right there. We send you an email with this commentary and stats every Monday morning. And then hopefully you're ready to jump on board with us and join the big leagues at subscribers.thesmallexchange.com. Those people are about to get a huge refresh in the data that we send out around products in about 2 or 3 weeks, because we're adding some more products and we're going to add a lot of data and information for our subscribers. So go to subscribers.thesmallexchange.com.
My friend is juggling.
Yeah, a lot of fun stuff. And so what I juggled for this week's newsletter, Pete, was this funny idea that I've gotten to witness now twice. I'm sure you've witnessed several times, which is like interest rates go to zero. Interest rates go to zero.
I was here when they actually built the Fed building back in the 30s. Yeah, go ahead.
Well, no, just like, but this happens. This happens with like market cycles, because here's how the story goes usually. Like equities fall. The Fed steps in and brings rates to zero, equities rise, and then the Fed hikes again. But what's funny is that when we find ourselves between the cut to 0% and the hike off of 0%, you've got a lot of, Twitter trolls and market analysts out there who basically say like, oh, the Fed will never hike again. Like this is the new normal. We'll never come off of 0%. And I mean, I'm interested to see your take on this, but Pete, my take is like, it's an inevitability that they hike again, right? Like we would be in a truly intriguing environment if the situation was we're at 0% in short-term rates, the economy recovers from that cut to zero, and the Fed never lifts off zero again. Doesn't it seem more a question of when and not if, or am I wrong?
No, I think it's definitely when. Sorry, I'm just trying to organize my thought. I think it's definitely a question of when. Rates will trade appreciably higher at some point. And that cycle you just walked through is that cutting and the raising. The raising is because the economy is expanding, goods price inflation comes into the marketplace. Okay. Inflation then is, by raising rates, it makes investment less attractive, which slows down the economy. Again, the rates are used to balance, but we're in a very odd world now. So that cycle doesn't work. Friday, month end, Fed fund rate. Now, remember, you mentioned it, it's at zero, but really it's between 0 and 25 basis points. They like
12 and a half basis points.
Right, 12 and a half to 15. It traded 5 basis points Friday. So, and they were pouring everything they could to get the rate not to go below zero. So there are weird mechanical stuff which speaks to that short end and when we move, but absolutely this cycle, like anything else, I don't get the logic behind, here comes $6 trillion more of debt that someone has to buy down the pipe on top of everybody else, and zero is going to be maintained forever. And I think the illusion is, and I'm sure we'll talk about it a little bit, it's perception of the market. It's not what the Fed does. And oftentimes we've lived through the cycle of the market doing exactly what the opposite of what the Fed says. Sure. So we're not in that world right now. We're in a very complacent world where they say, well, we're going to keep rates lower longer. It's like, you really don't have that choice, but I'd sell it as long as you could.
Yeah. So you bring up an interesting point, which is the inner workings behind the Fed hiking again. What we've seen recently is the market kind of forcing the Fed into hiking. And what I mean by that is at some point, we see the stock market crash of 2008. The Fed takes rates almost immediately in just a couple of cuts, goes from hundreds of basis points to 0%. And that's usually what happens when you're in a market crash there. Now, the market recovers back to where it was by like 2012, 2013. The Fed doesn't hike again until 2015. But what happened, and that's when I was actually cutting my teeth at the Chicago Board of Trade, is the market and traders started to lift those rates, the expectation of those rates, off of 0% before the Fed even came out and said, hey, we're going to hike. And that is what I am at least using this anecdotal evidence to show, like, that's what's going to happen at some point. Now, the question of when we'll get into right here, but at some point, this recovery has already gone through levels where we were prior to the COVID crash of early last year. At some point, these traders are going to take these expectations off of zero, and the Fed will be forced into hiking those rates. Now, let's get into that question of when. Looking here at the implied short-term rates, by the end of each of the next 3 years, using Eurodollars, you can see that I, first of all, messed up the copy here on the right side of the page. So just forget about that.
That was me. Once a month, I make the slides. So there's usually a problem with that. Remember the old days where I used to make the slides and you loved to always pick on the one mistake that was in there?
That is very true. A little behind the scenes of how we write the show here. But yes, what you see here, Pete, is a very different environment than just like the headline of Fed funds rate at zero. By the end of 2021, by the end of this year, we only have about half of it left. They are expecting that this rate will be around 25 basis points, which is kind of where we're at. Although you said, they're trying to bring that thing closer to zero. There's an expectation that we're at least a little bit north of zero, kind of around where we are right now. What's interesting to me, Pete, is that by the end of 22 and by the end of 23, we are considerably higher than where the Fed is projecting us to be. What say you on this?
Right. And the 20, again, you're using Eurodollars, which are a little bit different than Fed's funds rates, but that's just a rounding error. Let's not even go down that rabbit hole. So 25 basis points, 21, they're looking out. So basically moving traditionally in 25 basis points increments. So they're looking for one hike in 22 and two in 23. Now, for me, it's interesting. So this positive term structure off of the zero bound, it makes sense. But, before the pandemic, we were at 150 basis points. So is that a lot of juice built into it? From where we are now, yeah, 3 rate hikes is over 2 years. I don't know. That begs the question of is it too much? It's interesting to think that, they moved from 150 down to 50 down to zero in 2 cuts. Now, we're taking almost 2.5 years out here. And the best the market, when I say the best the market can guess today what 90-day rates are going to be 2 years in the future, or they're willing to stake a bet on, is 1%. It's very interesting. So for me, I take away that the curve doesn't seem, and I'll be interested to hear your thought. It seems realistic as pricing in a little bit of tightening, but it doesn't price in too much for me. I don't think.
What I think is just particularly interesting, and you do bring up a valid point, and that's why we're having the discussion today, is because the Fed will cut, and this makes sense to anybody who kind of understands the relationship of like cutting rates in times of economic turbulence as opposed to hiking them in solid economic times. Obviously, that turbulence picks up faster than just like general economic growth. That's a slower thing. So obviously cutting does happen faster than hiking. As Pete pointed out, they cut 150 basis points or 1.5% in the matter of about a month. And usually it takes them a couple of years to put that back in the market. Now, that being said, Pete, I will agree with you that like this seems reasonable. And what's interesting about this, looking at 21, 22, and 23, that's about a 2-year time frame, which lines up really exactly perfectly with where you would think the 2-year yield is. Right. And so what's really kind of intriguing to me is the fact that Eurodollars, which I think you and I both agree are extremely good indicators of where the market thinks rates will be in the future, they're saying that the Fed is likely to hike a couple times in the next 2 years.
Right.
The 2-year yield is right now it's down today again, right now sitting at 16 basis points, miles away from 100 basis points that are built into the Eurodollars that are 2 years out. Those durations are starting to line up. I know that they're different products, obviously, and you can look into the minutia of that on your own if you want, but this seems like a disconnect here. And the question, of course, is when will this happen? But what I really like about this trade in the S2Y, and given the context of the Eurodollars, is there's no projection right now, and of course things can change, that the Fed will go through zero. So you do have a little bit of a semblance of a boundary from the long perspective here. Now, Pete, the only thing that is the inhibitor for me from buying S2Y is when will this happen? Well, what's nice about this is with the S2Y futures, the only thing I have to worry about is just rolling out that exposure. The exposure stays consistent. And at some point, I'm just banking on this going from 16 basis points up to 25 to 50 by the end of 2022 and 100 by the end of 2023. And I really see that kind of falling in line. And the risk being that, they could go to zero negative. They haven't ever before. But I just continue to see this as a solid potential trade, and one in the futures market that costs you $60 to put on and is really right now $160 trade. It doesn't get that small or efficient as that in any other futures market when you're talking about rates.
Would you go as far and see we traded a lot more Eurodollars than we did before. We used to than we have.
I've traded literally thousands and thousands of them.
Right. And partially because we've been in this zero rate environment and it really doesn't move. For me, one of the things that I do watch is when that curve starts to move and those incremental raises start to diverge from what the market expects. Everybody's looking for that long end of the yield curve to drive equities lower. At some point, yields are going to rise to a point where equities are going to fall. From my experience, it's this short-term piece, whether you're using the 2 years as a synthetic representation of that is the driver of that interest to a greater degree. So I wouldn't go as far as calling 2 years big long 2 years a synthetic short in equities, but it is an interesting piece that I think will be part of the driver of a down move in equities when we see it. So this continues to be, we've had this in inventory. Since it launched, really, I think we've had long 2 years with the proxy that the zero bound is a struggle to be broken. The relative term structure is incredibly odd. And even if we don't see a rise in 10s and 30s, we can see a normalization in 2s that provide us a tradable opportunity. We've never played this from the short side. We've played 10s, 30s from the short side and the long side, but this consistently, and I think this is kind of where you're going, is that at some point, this has to move to maintain and hold this position for $60 and be able to roll it forward. It is probably one of the most efficient ways to trade that extreme as a directional trade and trade that probability.
Yeah, I totally agree with everything you said there, Pete. A great wrap up there. And the last
thing, segment, Frank. Yeah, I like this.
The last thing that I will say here is, the only pain to me really is having to roll it and being like, when are they going to do this? When are they going to do this? It's the name of the segment today. When will they finally hike again? What you'll see, though, and this happened last time, the Fed went from cutting rates to hiking rates. And I mean, using that historical context, that's what I'm going off of with this trade, is it's going to change like that. Like at some point, the whole traders, institutions, everybody is going to flip from 0% for the foreseeable future to, we're in a hiking environment now. Right. And I'd rather kind of sit with this $60 in margin, not taking up that much cash per contract in my account, maybe have a couple on there, and having to roll and not have to miss what has happened time and time again historically, which is the question of when, not if, the Fed will probably hike again.